Is the stock market bleed out going to continue, or are we finally getting near some kind of exhaustion point? Well, luckily, we're going to get a whole bunch of economic data to tell us the difference here this week. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. As ever, if you're watching this on YouTube, do feel free to jump in the comments. We always appreciate it. Give your thoughts, give your opinion on whether stocks have bottomed, whether they've got more losing to do, or whatever else might be on your mind. And we'll incorporate that into the show going forward. What we're going to focus on today is another piece of economic data informing this narrative that's going to be with us over the next 24 hours. That, of course, the service sector ISM report. That's a version of PMI, or Purchasing Managers Index, from the Institute of Supply Management, which focuses on the US and Canada. And we're going to seek to essentially answer the question, is this data going to move the needle on what's been happening in markets here, with stocks coming under increasing selling pressure? Needless to say, we're going to have to figure out why that selling pressure is occurring and what it is that's actually motivating these markets, which is what we're going to try to answer as we go. We're going to try to figure out what these moving parts are doing, why they're doing it, and why the end result has been such a stock market sell-off. We're going to then see if anything in this data is likely to give us any more things to worry about, or if perhaps finally something of a respite is on the menu. So let's begin here with a look at expectations. This right here is what we're looking for from this ISM report. And as ever, this is done in the logic of PMIs. So 50 is the center line. That's neither growth nor contraction. Above 50 is growth. Below 50 is contraction. And the further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. We saw the manufacturing ISM number earlier this week. It gave us a slight improvement on the manufacturing side, but it remains in contraction territory, 49 on the index. So starting to get a little bit better. We can see that the pace of shrinking has been easing for the past several months, but it's still shrinking. On the service sector side, we actually had a fairly decent run over recent months. We've kind of edged up into the top range for growth since we've sort of started to anchor around the beginning of this year. And the expectation for this next set of numbers is that we're actually going to hold the top of this range and come in a little bit. The service sector growth is going to slow some. Remain positive, but slow. This, of course, is going to be very interesting in terms of the subcomponents as to what actually makes this up. Because, as ever, there is a Fed calculus element here that seems to be absolutely critical for why markets are doing what they're doing. So, let's consider what it is that we are looking at first and foremost, with a view on what some leading data might tell us. Here we have the S&P Global version of PMI numbers. So this is essentially the same kind of index, also a diffusion index with a central line at 50, working exactly the same way as we've just described, but this one comes out earlier, and it's from S&P Global. So what we see here, not surprisingly, does not sound especially encouraging. As of September's numbers, we can see indeed manufacturing improved a bit. That comports with what we saw for the manufacturing ISM. On the services side of things, what we look at is deeper slowdown. And of course, that also lines up with what the expectations here are. But the look here looks a lot more daunting. So there appears to be so much of a downturn here that composite growth, which brings together services and manufacturing, is essentially at standstill. Now, obviously, these are slightly different numbers, and this is going to be slightly differently weighed, so we're not going to get exactly the same thing. We shouldn't expect 53.5, which is the expected number for services, to actually register at 50.2. But what it does give us is a sense of direction and a sense of where this is trending, because of course these are different surveys, but they're describing the same economy. And so the story might well be, on balance, continued slowdown. If we consider that in the global context, well, this is very much the story that we've seen writ large. Manufacturing that's been anemic the world over, a service sector that enjoyed a nice pop at the beginning of the year through much of the first half. That pop has since crested, and we've now seen deceleration. So much so that the global economy itself is now next to idle. It's growing, but very, very slowly. And that rate has come down significantly. Now, of course, we've talked about this being a risk of global recession if that number dips below 50. And what we're ostensibly going to get from this ISM number with a lower headline ISM services index is a step in the wrong direction, a step closer to that sort of a scenario. Because as ever, the global economy is powered by three main sources of growth, of which the US is the largest, China is the second largest, the Eurozone is the third. The Eurozone is already in recession in all but name. All of the leading indicators seem to suggest it at this point. We don't have confirmation yet. We don't have 2 consecutive quarters of regional contraction yet. But all of the leading numbers seem to indicate that the economy has already been shrinking for 3 consecutive months region-wide. Meanwhile, Germany's economy shrank in the second quarter. All of this seems to suggest that Germany probably shrank again in the third quarter, and the region is on the cusp of recession, if not firmly, definitively in one. So that's one node. China still can't get off the mat since the post-COVID reopening in December. Growth never really picked up like the promise of reopening the world's second largest economy suggested it might, because of course, China reopened nearly a year and a half after post-COVID stimulus growth crested for its major partners, for its major export markets, the US and the Eurozone. So in some sense, yes, China is its own node here, but it's also dependent on the other two. It needs end demand from the other two. Much like the rest of world 43% here are oftentimes dependent on the other three, China, the Eurozone, and the US, for their demand. So yes, technically the three only make up 57% of the global total, but it's actually much more impactful than that, because so much of the remaining 43% look to those three as vendors, look to their customers. They depend on demand from those three to sell them things, to have growth, to contribute. And so, and of course, there's very obvious examples here. Let's say Canada and the US, Australia and China, most of Central Europe and Western Europe. The story repeats regionally. And so what we're looking at then in this environment where the U.S. seems to be slowing as the service sector, the largest part of the economy, inches down, is a scenario where global growth has very few legs to stand on. There is the very difficult situation in China where growth never really, as we say, got off the mat. And that's, of course, created huge knock-on effects, be it the melting down of the very leveraged housing and real estate sector in China, be it anemic exports and imports at the same time, on and on and on. In the Eurozone, as we say, the situation is already recession in all but name. And the resilience left in the U.S., despite these slowing conditions, despite this inching toward recession on a global level, the resilience in the U.S. is under fire. And the reason it's under fire, largely, is that the Fed has insisted that it will keep interest rates high, that it will not respond to these conditions because it's still in inflation fighting mode. And we can see that looking at inflation expectations and how they've evolved. So we can see here that whichever is your favorite measure of inflation, the Fed's favorite is the PCE. Most of the world looks at CPI. Either way, we see that the market's own inflation expectations, be they baked into the 2-year break-even rate, which is the bond market's expectation, or the 1-year USD inflation swap is a swaps market estimate. It's a little bit shorter term. Whichever thing you look at, we can see that since essentially the beginning of the year, inflation expectations haven't really gone anywhere. If anything, they've anchored. And they've anchored around levels that the Fed ostensibly isn't comfortable with. The 2-year, in particular, is stuck at 2%, which means the Fed, assuming nothing at all goes wrong, just barely gets to its target within a 2-year window. That's not at all encouraging for a Fed that, of course, sees the capacity for all kinds of things to go wrong. We have a war that's still ongoing on the European landmass between Russia and Ukraine, and a lot of the regional actors are, as ever, involved. We've just seen elections in Slovakia give us the threat that the Western consensus might crack. We have another leader there, it looks like now, that is a little bit more skeptical of Western aid for Ukraine and a little bit more Kremlin friendly, much as Viktor Orban in Hungary is. And so it seems like there's scope for instability there. We have an attempt by Saudi Arabia and its OPEC allies to restrict the flow of oil, and the impact that has on inflation is some factor here. We have all kinds of uncertainty around the U.S. political landscape, not only as we head into recession, but as we have some continued tumult around debt financing and the debt ceiling and a possible government shutdown. Now it seems to have cost House Speaker Kevin McCarthy his job. So there is no shortage of reasons to think that something could get off kilter, but the market is saying, even as the Fed has done all this tightening, and even as a lot of the risks that might have encouraged immediate rate cuts have faded, and we're talking about the banking crisis from earlier in the year, the earlier episode of debt ceiling shenanigans in the first half of the year. Even as all of those adjustments have been made and now rate cut expectations, at least for this year, are non-existent, and rate cut expectations for next year are getting trimmed, inflation expectations aren't really responding. And that's a problem for the Fed's reaction function, because if any of these things end up being a little bit more inflationary than expected, well, then if the Fed is already priced for perfection, then it is not exactly in a situation where it would be able to do much about that. Or certainly it would be stuck for longer. And so as growth cools, and as the U.S. gets closer to joining these other economies on the economic weakness side of things, the Fed is understandably looked to say, well, you need to give us some aid here. You need to start talking about rate cuts, because we need to start to believe that you're going to backstop growth from getting too weak. But the Fed's inflation calculus would suggest this is not the time, and that higher for longer interest rates will persist. How does the Fed unstick this? Well, first step to answering that question is to find out where inflation comes from. And we can look at the CPI version of this data or the PCE version. It tells exactly the same story, but we'll look at CPI here just as a reference point. We can see here that most inflation is still contributed by core services. So services excluding energy and excluding food. We can see that, in fact, core year-on-year inflation has been going lower, while headline has popped here recently over the past 2 months. That's right here. So you can see the dotted line, which is core, is still going down. The headline has gone up a little bit. We can see that it's not from food, because that component is actually not increased. It seems to be coming from this here. So from energy becoming less of a drag on overall inflation. And that, of course, comes with higher energy prices, because the markets, at least so far, have believed those Saudi threats of cutting output, and the price of crude oil has gone higher. So this seems to be mostly how you explain that. But none of that changes the basic bottom line, that most of the inflation lives right here. When you start to unpick, is it the little blue area being a little bit bigger, or the little yellow area down in negative territory here being a little smaller? Now you're really just tinkering at the margins. For the Fed, it's addressing this big gray area here that is in question. And so it makes sense to have a look at what makes that area up. And we can see here it's overwhelmingly shelter. Now, this component just basically speaks to the cost of housing-related services, including an expectation of what rent would be even if one were an owner-occupier, to basically get a sense for how entrenched this is. And not surprisingly, the Fed can't do much about this, because much of the reason that this exists is the Fed's own doing. Those rapid rate hikes that we've been watching for the past year and change have essentially created a situation where the mortgage rate that's on average outstanding for loans already on the books is about 3.6%, because most Americans have fixed 30-year mortgages, and they locked the rates in before the rate hike cycle. If we look at what's available in the market now, it's close to 4% higher, or 400 basis points higher, 7.6%, give or take. Well, that's not clearly an environment where somebody wants to sell their house just so they can finance a new one 400 basis points more expensive. So there's been a collapse in existing home inventory. There have been no movement to unstick this market, because nobody wants to be a seller. So the price is locked in. So housing inflation is stuck. until there is some dispensation from Fed rate cuts. But of course, the Fed can't cut rates if inflation expectations won't come down. And so the question then becomes, well, where does the Fed have agency to actually have some influence on this if it's not shelter? Well, it's everything else. And looking at everything else, one lands at the one spot that the Fed could actually have an impact in and is having an impact on. That's the labor market. We can see here that labor costs, that's ECI, the employment cost index, they've fallen much less than overall inflation. Overall inflation has come down rather by multiple percentage points, down from 9 to just under 4 on CPPI. So we're talking over 5%, down from 7 to 3.5. So we're talking over 4% for PCE. But looking at the employment cost index, it's down less than 1%. And that's in part, and to a significant degree, because there's still a significant labor shortage out there. Now to the tune of about 2.5 million workers. And once we get the labor report at the end of this week, we'll be able to update this and see if it's gotten better or worse. But as of now, as of August, essentially, we're looking at a 2.5 million worker shortage still, which is, you can see here, greater than history, even though this has been building up a little bit before COVID. The gaps there were much smaller. And here still, we have this overhang, which is keeping wages elevated and which is keeping the labor market tight. Now, we just saw evidence of just how much the market is worried that this is not adjusting fast enough as the global economy cools. Because if this is the part that the Fed can have agency to actually do something, this is what's keeping them from cutting rates. They would like to see this start to really work to bring down baked in inflation into the labor market. But of course, the only way to do that is layoffs. And so far, the jobless rate has been near historic lows, and the layoffs haven't really picked up steam. You need those layoffs to reset wage agreements at lower levels, and that's not really occurring here yet. What there has been is a slide in job openings. And that's accounted for lower labor demand numbers. But of course, we just saw in spades earlier today when the job openings numbers for the past 2 months registered higher than expected, 9.6 for August versus 8.8 expected, and the July number revised higher from 8.8 to 8.9 million. And the response from markets, of course, consternation and more stock selling. Because what that means is that this mismatch continues to hold. And as long as this mismatch continues to hold, the Fed is in no hurry to deliver any kind of relief for what is, in fact, this and this. So what we end up with then is a situation where, because the labor market is so far still resilient, the market looks upon this data and says, we are nearing global recession, but the Fed won't step off this higher for longer rates path because it still has an inflation expectations issue it hasn't resolved. And so we're not going to get any help with this recession, at least not yet. And the response, interestingly, has been a swelling of uncertainty premium in bond markets. Notice what we see here. Now, of course, these yield lines, the 10-year and the 2-year, are normalized on an index from 0 to 100, where 100 is the base. So 100 is where we start here, and then you can see there's some net declines, some net rises, but I normalized them so that they can be easily compared apples to apples on the chart here. And you can see most recently in particular is where the current situation really starts to show itself. You see that the long end of the yield curve, 10-year yields, are rising while 2-year yields have basically stalled. And this essentially tells precisely the story that we're discussing here. The 2-year yield is the most sensitive to Fed policy, of course, because the Fed sets overnight rates, and this is the short end of the curve, the short-term rates that are the most sensitive to that. So not surprisingly, they're standing still because the market says, well, the Fed is in no condition to actually go anywhere. They need to keep rates steady. They certainly don't want to hike them into this kind of pain, but nor are they in position to cut them. Meanwhile, the 10-year yield has continued to march higher. And so naturally, the markets have asked, well, why is the 10-year going up, as is the 30-year? Why are bond yields going up at the long end? Well, it seems to be explained by what's going on in these yellow bars here. Now, the term premium is essentially the excess return that investors demand to lend money over a longer period of time. So just consider, if I lend money for 2 years, that's 2 years in which somebody can lose their job or suffer some sort of debilitating situation, or somehow or other lose income and lose the ability to pay. It may not pay me back my money. With a 10-year yield, that's 8 more years that something could go wrong. So the risk is inherently greater at 10 years versus 2, because there are just more years in which things might turn such that somebody I thought was an eligible borrower becomes not that. And for this reason, typically, you get a normal yield curve, which is incidentally not what we've been seeing. We've seen an inverted yield curve, where interest rates have been higher at the short end, lower at the long end, because we've been in the middle of a rate hike cycle, and because growth has been slowing. So what we see now in the buildup of this term premium, the excess return that investors demand for lending for a longer period of time versus a shorter period of time, is this greater uncertainty about what the Fed is going to do when the market is hoping against hope that we are going to get some kind of action as global growth sours. As a matter of fact, you can see this term premium really started to build around July. Well, what do we know about July? That's precisely where stocks turn a corner. So here, I've taken those same yellow bars here, I've made them into a line for easy comparison, and we can see as the term premium rises, which means as uncertainty in bond markets is priced in to a greater extent, stocks decline. And the through line here necessarily then becomes, as the markets see the Fed delaying longer and longer on giving them a lifeline with some rate cuts, we get deeper and deeper toward a global recession threat, all of which might well get encompassed in this ISM report, where we're going to get the sense of overall growth slowing, perhaps even as hiring remains sticky and prices hold up as a consequence. So this is where the moving parts land us. This is the outlook for what the Fed is going to do over the next year and change. And what we see here is essentially a situation where there's about a 53% chance that we're going to get one more hike. So we're right on the dividing line. With growth cooling, that's probably not a very strong sort of probability, but we can see here 30% chance that we're going to get a rate hike in November, 22% chance that we're going to get one in December. That's these numbers right here. So 22% here, I should say, that we're going to get one in December if we don't get one in November, which is a key caveat. And then a further 1.3% chance that we'll get it in January if we don't get it in December or November. You can see that cumulatively adds up to 53, 54%. But of course, the actual likelihood of a change at any one of these meetings is well below 50%. So the market doesn't expect any more rate hikes. Cuts start to enter the picture at this point, relatively late in the game. We start to look at cuts really in July. This is where, although the meeting probabilities between July and September are about 50-50, 46 and 51, it does look like by September at the latest, we already have a full cut that's priced in, and by December at the latest, 2 of them are. So whatever this ISM report is going to do, the way it's going to have an impact on markets is going to be right here. If we are going to have weaker growth, that will, of course, be a force that's pulling on rate hikes and tries to shift them forward in time because the Fed needs to do more to support growth. But if that weakening in the overall service sector comes with sticky inflation and with a pickup in hiring, as the leading data seems to suggest, the S&P Global PMI spoke to this, that hiring actually picked up in September. That would comport, of course, with the increase in job openings in August that we just looked at. And if the price part of the story stays sticky, in part because we still have a warm enough labor market to keep wages elevated, well, then we are in a situation where the Fed isn't going to be in a position to cut very soon, which pushes in the opposite direction, pushes more towards stasis. All of which says, again, we're getting closer to global recession, and the Fed isn't only not helping, it's ostensibly doing some added damage because it wants the labor market to turn over, interestingly enough, because that would unlock its ability to cut. So if how this lands ultimately ends up trimming rate cut expectations further, we can see there's now still a 41% chance of a cut, of a third cut next year. That's right over here. You can see 2 cuts priced in, 41% chance of a third right there. This is how this has worked out. The gray bars here are the amount of rate cuts in basis points expected between now and the end of next year. It's down to about 67, which means, again, 2 cuts and some chance of a third. As we see here, about 40% chance. As that's come in from as many as 6 cuts, or cumulatively about 175 basis points in cuts, or 150 basis points here to here, stocks have fallen. Which is just another way of saying, as there have been fewer cuts priced in, uncertainty, by way of the term premium has moved into the market because recession risk will ostensibly be allowed to build unchecked for longer. We can likewise see that as this same thing has been happening, the US dollar has been going up because more and more liquidation has occurred and more capital has gone into cash because of this extra uncertainty. And so if this ISM number gives us more of the same, well, then one might expect more of the same. And so stock markets might continue to head lower, even as the dollar keeps going higher, as long as the markets still think the Fed is going to continue whistling past the graveyard of global economic growth. And that is macro money for today. As ever, we are here Monday through Thursday, every single week, right after overtime, a show that I co-host with head of futures and forex Chris Vecchio here at Tasty Live, where we try to figure out the day's events and try to put together some sense of what might happen next. We're frequently joined on that show by the great Dylan Radigan, so definitely check that out. I'm also on with Chris for a Futures Power Hour on Friday, on with Tom and Tony for First Call on Sunday evenings, writing for the News and Insights section of tastylive.com. In fact, a summary of this very session is there presently. And opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Happy trading out there. Jump into those YouTube comments, please. And we'll see you tomorrow. Take care.